Hey, what's going on, guys? It's your boy Freddy. Welcome back to the channel. Today I want to go over my WealthSimple dividend portfolio and show all of the stocks that I've added to and bought since my last update. You guys have probably noticed that the market is pretty choppy right now, with some green days sprinkled in with a lot of red days, especially for the Nasdaq and tech stocks. However, for many of you who have more dividend-oriented portfolios, your stocks are actually up quite a bit right now, as we saw a market rotation away from tech stocks and into more value-oriented ones. In my opinion, I believe that a simple dollar costing method where you simply put money into your portfolio on a regular basis, regardless of what the state of the market is, will give you the highest potential for success with the least headache. Instead of having to worry about large drops in your portfolios, market rotations, and thoughts of selling, you would tune all of that out and simply put money into the market and let it do its thing. I believe that the hardest part of this whole process is to break the mindset that when stocks go down and into the red, it's time to panic. If you can break that mentality and realize that as long as you're buying high quality companies, buying on red days simply mean that you are buying on sale when looking at the bigger picture. It's always a good idea to keep a little bit of extra cash around in your portfolios so you can take advantage of these red days when they come around. Having this extra cash in addition to your regular deposits mean that you can both dollar cost average and add more heavily when the market dips. My goal for 2021 is to get this portfolio to produce an average of $50 per month in dividends. Right now, after calculating the current dividends I've received, I'm at about $14 per month. So I do have quite a bit of the journey ahead of me over this next year, but I definitely think it is possible, especially as I continue to save as much as I can and invest in high quality companies. So I don't have a set number that I choose to save every month, and instead have a goal to keep my checking account as lean as possible. This way I get my money working for me as quickly as I can, and it helps me stay away from any unnecessary spending. Now let's get right into the portfolio and see how it's changed over the last month. Over this last month, you guys can see that I'm basically flat and had 0% growth. This is because of the drop in the Nasdaq that my portfolio does have quite a bit of exposure to, but in the long run, I'm not worried about this drop at all, and I have a strong belief that tech stocks will be able to rebound and continue to grow. This is one of the reasons it's absolutely vital to have a diversified portfolio, because although the Nasdaq is down about 8% from its all-time highs, which is a pretty big drop, the rest of the portfolio has continued to steadily grow. Had I been all in on tech stocks, I would be more worried, as I would see the portfolio number absolutely plummet. So this diversification really does help me sleep at night. This could happen with almost any sector where, although the rest of the market is chugging along, that one industry is falling. So having diversity within the portfolio is absolutely necessary, as you can take advantage of the growth in every industry. My strategy here on WealthSimple does lean more towards growth than it does dividends, but there is a few very important dividend companies that I make sure to add to on a regular basis, and I am always looking for more fundamentally solid dividend companies to invest in. The biggest position in my WealthSimple portfolio is still VFV at about 35% of the overall value of the portfolio. This ETF tracks the S&P 500, and if I could only own one stock, this would be the one. With VFV, I get exposure to over 500 of the largest companies, which historically have given about a 10% return. To show you how remarkable that really is, let's say on average you invest about $830 per month. In 25 years, you would have over $1 million. By just investing in VFV, you're able to mimic the returns of the market and have the potential to receive a return like this, which is absolutely amazing. For some of you who may not be investors just yet, you may think that is a long time before you can become financially independent. And of course, that is a good point, as time is the most valuable and finite resource that we have. So what you could do is simply invest more on a consistent basis. Say instead of putting in $830, you're able to double it and put in $1,660. Well, now instead of retiring in 25 years, you could shave off 7 years and retire in just 18. It's all about finding the right balance and putting in what you're comfortable with while not having it affect your quality of life in a major way. Since my last update when I had 37 shares, I am up to 41 shares, which is right about where I want to be, as I try to consistently add about 2 to 4 shares per month. The next company in my portfolio is Bank of Nova Scotia, and this stock has absolutely blown up over the last few months, and I couldn't be happier with both the dividend and the company as a whole. I have been toying with the idea of increasing my diversity by investing in a Canadian banks ETF like ZEB, as I'm a big believer in the Canadian banking system and the dividend growth that I believe it will have in the future. By investing in this ETF, I'm not betting on just one horse to win the race, and instead investing in the entire banking sector as a whole. But one thing that is preventing me from taking the leap is the absolutely massive management fees that go along with investing in one of these ETFs. Currently, ZEB has a management fee of about 0.61%, which doesn't sound like a lot, but going back to the compound growth calculator, we can see that the difference between 7% growth and 6.4% growth on $5,000 is about $15,000 in the long run. This shows that over the long term, that fee can add up to be a massive difference. I could of course just buy the major banks individually, but that would be a whole nother issue as I would have to constantly manage and update the numbers to make sure I have the proper weightings for all of the companies, which would take up a lot of time, and my goal is to make investing as simple as possible. Adding more steps to the process would take away from the goal of simplicity, and currently it's not something that I'm wanting to undertake. So there is trade-offs to both choices, and I wish we had something like M1 Finance here in Canada, which they have in the US, where you can create your own ETFs at no cost and can truly customize your investing to suit you, but unfortunately we don't and are stuck making these decisions. I hope one day they do come up here, as that would be an absolute game changer, so we'll just have to wait and see. Next up we have QQC, which is an ETF that tracks the Nasdaq. This stock is one of the reasons I am flat over the last month, as the Nasdaq itself is down quite a bit. This ETF, along with VFV, the other ETF in the portfolio, make up about 45% of the overall value, and I'm trying to get that up to 50%. I think that this is a good split between ETFs and individual stocks, as I get to take advantage of both growth with the ETFs and dividends with most of the individual stocks. I added another share of QQC and will be looking to add another one if the Nasdaq continues to dip. Next up is Telus, which is another solid dividend company in the portfolio that I'm going to continue to add to over the coming months. I have added a couple shares since the last update, nothing too crazy, as I've put a lot more focus on stocks that have been dipping like QQC. Nonetheless, I have no complaints about the company, and I've made a video talking more in depth about the business model that you guys can check out, and I'll leave a link to it in the description down below. One thing that I did want to talk about is the deal that Rogers made to buy out Shaw, which are both major competitors to Telus. I don't believe that this will have a major impact on Telus' business, and we shall wait to see if the deal can actually get approved by the Canadian government, as it goes against the competition that the government has been urging these companies to pursue. Let me know your thoughts on this purchase. I would love to get more information on the topic, and if you guys want a video going into further depth about the merger, also let me know. Just as I was finishing this video, Telus actually had a share offering for over $1 billion, which caused the stock to dip about 3.5%. This share offering was done to raise capital for expanding their 5G infrastructure. This to me sounds absolutely amazing. They are increasing their investments into the future, and I now get to buy the stock on a nice dip, which is a win-win situation for a long-term investor like myself. The next company in the portfolio is Canadian National Railways. I haven't been focusing much on this stock as I've been going after more companies that have been dipping, but since I made that video talking about the dip on Canadian National Railways, the stock has been shooting up like crazy and now is up over 8% from when I bought in just a couple months ago. I have a whole video dedicated to Canadian National Railways where I take a deep dive into the company's financials as well as the overall fundamentals of the company, which you guys can also check out in the description. This stock has periods of extreme uptrends but then also comes down, so I would wait for another dip in the company, which I believe is on the horizon. If you guys have been listening to the news, you may have heard about the large cargo ship that is currently blocking the Suez Canal, which accounts for over 12% of the world's cargo travel. This is a bit of a speculation, but it is possible that the stock could dip because of this bottleneck in the shipping process. But if not, there will come a time when it does dip a bit. And if you aren't worried about short-term profits, then simply dollar cost average in and hold for the long term, because this company does have a lot of growth potential ahead, and the dividend is great for what the company offers. I still have my one share of Tesla in the portfolio, and it is a bit of the reason for the lack of growth over the last month, as the stock has been dipping from its all-time highs from 900. But I'm not worried about this company at all in the slightest, as it is one of my highest conviction companies that I believe in, and the growth potential that it offers is absolutely insane. I have been doing a lot of research on ARK ETFs, which have a lot of exposure to Tesla and other high growth potential companies. And if you guys would like me to make a deep dive on ARK-K, which is their flagship ETF, I can for sure do that, so just let me know in the comments down below. The last dividend player in my portfolio is Algonquin Power and Utilities. I'm using this company as both a utility company and my exposure into green and renewable energy. It is a super solid company with excellent growth history that still has a lot of potential for many years to come. I've just started to build out this position and I have about a dozen shares at the moment. I'm going to continue to add about 2 to 4 shares per month and hopefully put a lot of my dividend returns from the overall portfolio back into this company. The last company I want to go over in the portfolio is Air Canada, and as you guys can see, I now own just one share of the company. Over the last month, I've been heavily trimming this position as the stock price has surged higher and higher, and personally, I believe that this valuation is pretty unjustified given the current revenues and the current projections of the overall travel industry as a whole. I will gladly buy back into this company if it goes back to the mid to high teens that it was at just a couple months ago, as I believe that is a much more justifiable price for the stock. My goal with this company was never to make a quick trade. It was to be holding it for 5 to 10 years and maybe even longer as the company slowly recovered and went back to seeing the growth that it saw before the illness began. I only put in a small percentage of my portfolio into it as it was a much more risky investment because the company did have a lot of potential to go bankrupt. but I saw that the upside was really high, so I was able to justify just putting in a little bit. But now that the stock price has surged, it no longer makes sense for me to be holding it, at least for the short term. So I have a few upcoming dividends in the portfolio that I want to go over. Telus is coming in on April 1st, Bank of Nova Scotia on the 4th, VFV on the 6th, Algonquin on the 15th, and CNR should be coming in any day now. So stay tuned to the channel to see how much I make from this round of dividends and how I plan to reinvest them back into the portfolio. Well, that is my update on the portfolio. Let me know in the comments down below if you want to see more frequent updates on the portfolio. I could definitely make one every couple weeks or every week if you guys are interested. So just let me know in the comments down below if you would like to see something like that. Also, remember to hit that like button if you enjoyed and subscribe for more investing videos like this. I also have a WealthSimple referral link in the description that gives you $10 when you deposit and trade with 100 or more. So if you guys did like the platform and what you guys saw with it, consider using that referral link to get an instant 10% return. I'll catch you guys in the next one.